What's going on, everyone? My name is Nicholas Merton here at Data Dash, and today is July 1st of 2020. Well, folks, I hope you guys are having a great day wherever you are, and in today's video, I want to spend some time to focus on a little bit more of a long-term video rather than focusing on the day-to-day movements in markets, and talk a little bit about my thesis for how I'm actually looking to invest over the next quarter, going through the summer months, talking a little bit about the current macro environment and also keeping that in mind when going about looking at what markets we're looking to allocate ourselves to. So as you all know, I'm mainly focused in crypto markets, and I also do have a focus as well in equity markets and commodities. And I also look elsewhere for other investment opportunities, maybe more niche commodities as well as traditional treasuries or government bonds. So we'll talk about all of that as we go through the video. But to start off, as always, our sponsor for today's episode is Deeper Network. A cybersecurity company based in Silicon Valley is about to launch an Indiegogo campaign. Its product, Deeper Connect Mini, is a small yet powerful device combining cybersecurity, blockchain technology, and a sharing economy. It provides its users enterprise online privacy and security, unrestricted internet access, and profits by sharing their idle bandwidth. The company will be shipping worldwide as it aims to create one of the biggest and safest decentralized private networks in the world. There will be a discount of up to 45% for early bird supporters. Click on the link in the description to join them now. We got to focus on the current environment we're in right now. So again, we're still seeing right now, if you take a look here, this is from Yardeni Research. This is one of my favorite resources to go to look for information on central bank monetary policy, as well as current statistics for the public markets when it comes to stock buybacks or dividends, things like that are going to apply pressure to certain markets like equities. We can see here that since here back in May of this year, we're still waiting for the June statistics to come out here in the next day or so. This is going to be showcasing us probably pushing around central banks from the four major ones: the Federal Reserve, the ECB, the Bank of England, and the Bank of Japan, as well as the People's Bank of China, coming up to an asset total of around $25 trillion. And it's a big leap from where we were back just about a couple of months ago before the world went haywire and we were at around $19 trillion. So a $6 trillion increase in overall central bank balance sheets. And the crazy thing is it looks like this is going to keep on going until we get up towards a valuation of around $30 trillion. That's my general target, sometime by the end of this summer. I believe we're still going to see a pretty excessive degree of introduction of new capital into the system. And outside of that as well, outside of central banks putting in base cash or an increase to the M2 money supply, in this case, we also have central banks putting interest rates either near zero or into negative territory. So we not only have countries, again, like Denmark and Switzerland, as well as Japan, which have already been remaining in negative interest rate territory for some time. But you've got a lot of other major countries. For example, the Eurozone, broadly speaking, at 0% interest rates. You've got Norway and Sweden at 0%, Israel down at 0.1%, Poland at 0.1%, the UK down at 0.1%, as well as a few other countries like Australia and the United States tailoring towards a quarter or less in regards to their effective funds rate for the central bank. Meaning that, again, the cost of capital is extremely cheap. And you can see here from the actual Fed website for the Federal Reserve that the number has dropped down from around 2.5 back here in 2019. And in less than pretty much a year and a half, we're down here to practically 0%. So if we're in this environment where central banks are printing crazy amounts of money, right, and along with that as well, interest rates are extremely low. And if we take a look at the yields of treasuries, for example, which can give us a good precursor as to what the Fed is going to do next, and especially when we're taking a look at U.S. treasuries, as we see this yield drop, we can be even more confident that this is a sign that the market is reading the Federal Reserve as well as other central banks are going to be lowering interest rates. The lower interest rates go, tends to be that the yields on bonds are going to be going down as well, right? If you go, for example, the standard asset in this case, that's the lowest risk asset on the market, which are government bonds, you're going to usually see the yield drop as people continue to push up the price of the asset, purchase government bonds, and more specifically in this case, treasuries. And that means that the Fed is going to put more funny money and lower interest rates as low as possible and probably teeter on negative interest rate territory here very soon. So what kind of ramifications is this going to have, right? I know I've rambled on a bit here, but building this into our understanding here of the current macro environment, we need to know what this is going to do for a wide variety of markets. And basically, it's going to benefit all assets. I know many people would probably tell you it's going to mainly benefit stocks, as the majority of new capital inflows are going to go into traditional markets. And that's a very true statement, but it's also going to benefit a lot of hedges in different assets across the world in different ways. The biggest benefit for something like Bitcoin, which is obviously our main focus here on the channel, is not only that we've obviously had a lot of things like the halving event, for example, back in the mid part of May, where we started to see a big reduction in the actual supply introduction of new Bitcoin. But outside of this as well, when you have a small market like Bitcoin, you have market to scale at play. So Bitcoin right now as an asset at the current valuation of around 91 to 9200 per Bitcoin is going to be valuating at around a range of around 170, 180 billion dollars for Bitcoin. And this is a very small market. It might sound like a lot, but that simple fact that, again, we're in such an early market, Bitcoin really has only been liquidly traded for about the last 9 years. If we're taking that into consideration, we're such an early market here, and the ability for this market to do a 5 or 10x in the next cycle is very practical, over the next 2 years. So this is why I'm mainly allocated towards Bitcoin as well as altcoins in the cryptocurrency space, and I do want to spend some time to talk about that. But again, understanding the environment here for Bitcoin in a world of Fed monetary policy, there really isn't any better asset. And the reason why is even though the majority of inflows of new capital from central banks aren't going into crypto markets, you don't need that much money to get crypto lifted up to new valuations. And as a trader and investor, that's what you should be caring about, is what's going to be the market that gets enough inflows, in this case, to do that 5 or 10x. Equity markets require a lot more money. So in this case, crypto has a lot of room to possibly grow and start acting a little bit as a hedge, in this case, against traditional central bank monetary policy. Looking at the SMS indicator, our custom aggregate indicator that takes in the squeeze momentum indicator, the MACD, as well as the stochastic RSI, we can see here that outside of the anomaly we had here in early 2019, where we had a major short squeeze in crypto markets, this is the first time here on the monthly chart that we've really gotten across to the 3-point mark and look like we're formulating for the early stages of the next uptrend. And again, I think we're going to hold up in this range for quite some time. I don't think we're getting a dip down below, to 5 or 4,000. If anything, maybe a pullback temporarily to 8 or 7,000. But that's the most bearish case scenario. And we're focusing again on a time frame for the next year to the next 2 years. Our peak estimate for Bitcoin is going to be around $100,000 in November of 2022. It's actually quite conservative compared to a lot of other estimates. That's Bitcoin around a $2 trillion market cap. And that's not too far off. Gold right now, in the early stages of its current bull market, is sitting around a valuation around $10 to $11 trillion. So I think this is a very reasonable target. So going on to take a look at altcoins here, next key thing to talk about, again, taking a look at the SMS, right? We can see here that we've been building into a very long-term wedge. We've had a nearly 2-year bear market for altcoins in this case, actually more than 2 years, as we peaked out at the beginning of 2018. So over 2 years, altcoins have been basically going downward or pushing sideways. And now we're getting to the tip of the wedge here, and it looks like we're starting to set up for a breakout. The SMS indicator, much like it did back here in January of 2017, flashing off signals that an uptrend is nigh, it's about to come soon. So this is one thing that we're watching for here. I'd ignore the volume because altcoins, there's a lot of fake volume in the crypto space, and this crypto cap indicator that we have here for altcoin dominance is not going to pick that up. So very important to keep that in mind. But ignoring the volume, right, we've got a lot of things like DeFi, enterprise blockchain. These are the 2 categories that I'm really focusing on. Yes, there's a lot of hype, there's a lot of noise, of course, but as a trader and investor, you have to ignore whether it's rational or not. It's the market, people act irrationally, and there's also a lot of actual fundamental good coming out of these parts that actually bring a lot of utility. I'm very passionate about what's going on at DeFi on a fundamental basis, so I think there's an actual narrative there that actually is going to be driving these valuations in the long term, as well as a lot of utility that's going to actually set demand for a lot of these systems. So again, keeping an eye on altcoins, again, that's where I'm mainly exposed, and I will continue to remain exposed as we go throughout the next cycle, so long as we're making sure we're on the right plays. So the second category of things we have to talk about are obviously commodities, more specifically precious metals. So taking a look at gold here, gold coming down on a previous long-term line of support, breaking out of what became a wedge over time as you took the line of resistance and the line of support and squeezing through. And over the last few years, since back here in 2019, we've really started to take off for gold. And again, this is an example of, as you guys notice, I'm not looking at the daily or the hourly time frames. As I'll drill time and time again, you want to focus on these longer term time frames. And the SMS, one of our our custom aggregate indicators, really good to be using. It's good to be used on the 1 month, on the 3 month, on the 4 month, and also in some cases, if you have a really long term market where you have enough price data to work with, it can be good on something like the 12 month, right? when you're dealing with markets that have these multi-year cycles, some like things like equity markets, for example, or commodities like gold or silver. So we want to watch for this here with gold coming back up here to all-time highs here, probably in the next quarter or two. This is going to give us a real opportunity going into 2021 to really see some parabolic movements for gold, especially, and again, as we're expecting central banks to continue pressing up towards, $28-30 trillion here going into 2021. And it could even go higher than that. If we see any kind of stunt to the economy or freeze in equity markets for whatever reason, don't doubt that central banks are probably going to continue printing more rather than taking more conservative estimates. Silver here as well, taking a look at the 4-month like we did with gold. Right? Again, we got a flip back here when we got the previous bull market, signaled here around $14 per ounce, all the way up towards around $50, right? And then started to flip as we get the first red quarter here. The first red 4 months here. And we can see here as well that we've been getting a period really over the last year here that's showcasing that we're likely breaking out of this descending parabolic line of resistance and breaking up towards much higher levels here over the next year or so. So again, the key thing to watch for here is the gold to silver ratio. And again, as I'm talking about allocation to commodities, and I'll discuss a little bit about what my kind of general percentages are for each of these markets in just a moment. But taking a look here at the gold to silver ratio, I'm likely going to be positioning myself again on the more high risk assets. So that's going to be silver in this case. It's a smaller asset, so markets of scale is what I'm factoring in here. That silver is much easier to multiply. It's a multi-billion-dollar market versus gold, which is a multi-trillion-dollar market. Gold's sitting around $10 to $11 trillion in valuation. Silver is talking about tens or hundreds of billions of dollars in valuation. So it's much smaller and much easier to multiply during these bull markets. It requires less inflows of capital. And that's why you see, with the initial kind of panic sell-off in global markets that we had back in March, you can see on the monthly chart back here in March, gold peaked out at a new high against silver. Right? You could buy 125 ounces of silver per ounce of gold. And that was similar to back here in 2008, where during the summer we started to have the initial major sell-off, where it went from 52 to 85. So this initially showcases that during panic times, people turn to gold. Silver usually sells off more, as it not only has higher returns, but also higher losses when it comes to commodities selling off. And then we can see here the dramatic pull down on the gold to silver ratio, where silver truly wins out. It's not that gold didn't go up, it's that silver excessively outpaced it. So silver is going to be the asset you're going to want to watch for in commodity markets. And, outside of that as well, there's a few other markets that some people ask me about, like palladium or copper, all these different other ones. I think palladium is a little too overextended right now. We'll keep an eye on it. But I think for now, silver is really one of the clear plays here. It's been something that you've had to be patient on for some time, and now it looks like it's finally the time for this market to start moving. All right, so taking a look at equities here, broadly speaking, the NASDAQ leading the way here. The major thing I would say, I'm not going to really dive into the Russell and the S&P 500 and the Dow Jones or any specific companies, but the key lesson here right now is to obviously see, as we've gone up to double, the peak valuation for the NASDAQ is practically double of what we set back during the dot-com bubble. The key message here is that fundamentals are out the wazoo. No one cares about them anymore. And we're, again, living in this era of constant guarantees from central banks, where we're going to start acting a lot like Japan here in the United States, where we're not just providing liquidity, which is going to inevitably boost up equities, but outside of this as well, the central bank is going to become a prime buyer. They've already started buying ETFs tied to high-yield bonds, junk bonds in the economy that are already high risk as is. So again, just like with the mortgage-backed securities, just like, for example, with buying up treasuries, all of these elements are going to leave symptoms across the board for the market. And they're basically enticing people to take excessive risk. And when there's excessive risk, there's a major potential upside. So that's what we're looking for here. In the sense of allocations, right? Now that we've kind of gone through and talked about all of these markets, right? All of them. You notice how most people usually would have one-sided opinions on equities or maybe crypto. I think all asset markets are going to do good. And the only question here is, how do you actually diversify and allocate your portfolio? Now, for me personally, I have a very different risk tolerance and different objectives than some other people. Obviously, everyone wants to win and be able to make money in the long term. But for me personally, I'm obviously of age as well as a position where I can take a little bit of excessive risk. And I do spend a lot of time analyzing markets. So I can take probably a higher sense of risk compared to someone who may not be as active in markets. So what are the market allocations that I currently have? For me personally, crypto is well over 90% of my portfolio. That's not something I would probably recommend. And again, I can't give any of you guys financial advice in this regard, but it's my biggest allocation. And the reason why is for those key selling points we talked about, right? Is we see with treasury markets giving us that kind of premature sign that the Fed, or at least the market is intending that the Fed is going to go back on its words, as well as other central banks, and going into negative interest rate territory, continuing to inject new capital or new rounds of quantitative easing and new lines of credit. This is going to push up all assets. And the key thing I want to look for is the asset that I know has the chance to actually multiply time and time again. And when you're talking about Bitcoin, that's probably the mainstream asset out of all the different options I have compared to maybe gold, equities, you name it, silver even as well, where Bitcoin has the most room to grow here as a new emerging asset. And then outside of that even more is what's going to go on in altcoin markets. We don't have the room to scale like we did last time where a 50 or 100x return is going to be standard for all cryptocurrencies. But there's going to be plenty of 10, 20x's. I know it sounds crazy and it sounds kind of greedy, but it's literally, it's going to happen. Again, guys, it's just a matter of finding the proper plays that are going to do that. And I have no doubt that some will do even better than that. If you're factoring that many of them will probably do a 5 or 10x against Bitcoin over the next 2 years, maybe even more. And the Bitcoin itself is probably going to do a 5 or 10x itself. So it's multipliers lying on multipliers as Bitcoin goes up and altcoins even further outpace Bitcoin, right? So again, I have a massive amount of allocation to crypto. And as you guys know, I'm already a big fan of the industry and the space as a whole. Outside of that as well, if you're talking about, probably about 90% exposure to crypto, I'm looking to do a split here about 5% here towards gold and silver, mainly putting my positions in silver in this case. If I'm actually owning the physical commodity, if I buy any paper ETFs like SLV or GLD, it's going to be mainly SLV. And I also might buy a slight bit of leverage position in this case, as it's a smaller portion of my portfolio. I'm willing to take that risk as well. So there's all kinds of ways you can do that. You can buy options, you could buy leveraged ETFs, but again, I don't think leveraged ETFs will work very well in the long term because you have decay in the valuation. So I would say that looking at options in this case, having some general time frames for when you expect silver to be at a higher range, and looking for some decent ones on the market. Outside of that as well, a 5% allocation for equities. So one of my plays that I have my 5% allocation in right now is Tilray. So the cannabis sector, I'm looking at a lot of not only cannabis plays as we're going into high risk, high reward territory with central bank monetary policy, but I'm also looking at a lot of new emerging industries that are going to be kind of copycat industries that ride on that same kind of hype wave, and that's going to be a lot of the medical mushroom technology that's again being looked at in Canada right now. There's a lot of new listings that are showing similar patterns to what cannabis did back in 2017, and outside of that as well, a lot of new tech industries as well. So I'm looking for a lot of the non-overvalued tech companies. I'm not really looking at the FANG plays. I think the small caps are about to have their run up here in the next coming months, and there's going to be a big divergence. If you really take, for example, a look at maybe, for example, the IXIC, which is the NASDAQ, which is going to be giving you a good allocation of those larger cap plays. I take a look at the ratio to the Russell 2000, right? And we can see here, we're reaching towards levels here where the NASDAQ, similar back to the dot-com bubble, is getting towards a range where the large cap companies are getting way too overextended, right? So we might have another quarter or so until we really get this reversal. But again, my equity positions I'm building up are going to be for about a year and a half to 2 years. So as we're focusing on that, we're going to be looking at the small and mid cap plays. That's always been my sweet spot when it comes to investing in equities, and we'll be excited to see what happens here over the next few months. So anyways, I've rambled on enough for today, guys. I hope you all enjoyed this video. If you do, drop a like. Again, to summarize, 90% allocation to cryptocurrencies, 5% to precious metals, predominantly silver, and another 5% for equity plays across the board. So, and one last thing to mention as well is that for those of you out there who want to get exposure to the two main asset classes that I've been focused on, which are cryptocurrencies as well as commodities, then definitely consider checking out our sponsor, Bitpanda Pro. They not only offer the ability to get deep liquidity for a variety of the major cryptocurrencies that you like. In many cases, they're referred to as the European Coinbase. But outside of that as well, Bitpanda also provides on its core platform the ability to get exposure to things like gold and silver inside your actual crypto account. So if you're interested in this, definitely check out the link down below in the description to learn more about it. But that's it for me, guys. Thank you all so much for watching, and I'll see you all in the next video. Stay tuned.